You're listening to Questioning Your Sense, where you get real-world, pragmatic tax and financial advice for business owners, entrepreneurs, and independent contractors. Here are your hosts, Kevin Molen and Charles Steinmetz.
Hey folks, welcome to Questioning Your Sense. Very happy to be joined back with our ever-present co-host, Charles Steinmetz. Charlie, you doing all right today?
I'm great. Almost ever present. I'm not always.
Almost, that's right. So we really enjoyed last week's podcast, our guest, Zach Majors from Centric Advisors. But as normal, I'm your host, Kevin Molen. We'll go ahead and jump right in. Charlie,
Sure.
As a segue, what do you want to tell me about today?
Honestly, I didn't have anything to come to mind. I mean, I took my break and still couldn't come to anything. So I'll do I'm rubber, you're glue. How about you tell me
Oh, wow.
something I'm talking about today?
All right.
Old school. Here's my thing. I like old school things. My mind is old school.
Fair enough. The 90s grunge music, I know certainly is your thing, and so I get it. Let's see, what do I want to tell you about today? Well, I set a goal to lose 20 pounds in 60 days, and I'm now 7 pounds down. And it's been 8 days. So, pretty successful?
Yeah.
I don't know.
For sure.
So that feels pretty good. Our topic today is rental real estate and real estate investing. This is quite a large topic, right? There's a lot to talk about, a lot to go over. Where we're going to be attacking this today is primarily from the landlord perspective, right? The buyer of real estate who leases it to tenants.
Sure.
And I'm sure we'll have future episodes and future questions in regards to other types of real estate investing. If you'd like to hear about home flipping and the tax implications of that and all that kind of stuff, of course, we can go into that. Just let us know. But we will start today talking about rental fundamentals. Rule number one when it comes to rental real estate is why, right? Why do you want to get into real estate? Do you want to be a landlord? Do you want to pay a property management company?
You're scared of the market.
That's right. One thing that I hear a lot is, well, how does a rental property help me on my taxes? I freaking hate that question so much.
It helps your bank account.
That's right. If you're doing a good job, then it hurts your taxes because you have more profit. Anyways, we'll dive a little more into that. But essentially, this becomes a question of, do you want to be a landlord? Because if you do, then getting into rental real estate investing is good. If you don't, then you need to pay a property management company, which means your profit is either essentially going to be lower, or you need to have lower overhead in order to create the same level of profit. And so that's usually what I ask people right out the gate is, do you want to be a landlord, right? Because if you don't, I've had so many clients get into, I'm sure you have too, they get into rental real estate and then they get out in a year or 2 or 3 because they can't stand the micromanaging aspect of what it requires to have a successful rental property.
Calls, having the one bad tenant, they get into it for a little while, they have that one bad tenant, and it's just such a sour taste, that one bad, and so then it's the management company or just the done.
Yep,
Yeah.
Absolutely. Beyond that, assuming you are looking for a profit from the rental property, then of course that question of how does the rental property help me on my taxes? Well, it doesn't, right? Because more income means more tax. So it's not going to reduce your tax. But after things like depreciation of the structure on the rental property and what expenses you get to claim against the income, the rental profit is generally taxed at a lower effective tax rate than wages, right? So if I wake up and I go to work and I earn a paycheck, I don't get to deduct those miles on the way to work. I don't get to deduct my any expenses in regards to waking up and going to work at a W-2 kind of primary full-time job.
Used to.
There's a way we used to. Most people didn't qualify, but yeah. Anyways, and so with the rental property, of course, every dollar is deductible in regards to how you can generate the income. So generally, it's a lower effective tax rate than wages. And so
the fact that wages have FICA, Social Security, Medicare, etc., which rental income, which we'll go deeper into in a little bit, but we'll have.
Yeah, absolutely. And so in that regard, it's a kind of a nuanced and complicated discussion. But how does a rental property help on your taxes? Well, it lets you earn income that isn't taxed at the same rate as your other wage income is. So how does it help you? Well, if you were going to earn $10,000 more in wages, or you could earn $10,000 in profit on a rental property,
Sure.
you actually end up more profitable earning $10,000 on a rental property than $10,000 in wages. So does a rental property help on your taxes? In the sense where you were going to trade one for the other?
Right.
Yes. In the sense where this is just added income? No, and you don't want it to. You want it to hurt you tax-wise. You want it to cause you to pay more in taxes because you have the corresponding profit. If you bring in 10 grand more in profit from the rental and you have to pay $2,000 more in taxes, thumbs up, you were profitable. You still walk away with 8 grand. That is the point.
When I was trained here, but about doing taxes, the person whose name was Joe mentioned to me his college professor hit him with something that at first reaction seems negative, like, why would you say this to me? Of the professor saying, I wish, my desire is to pay $1 million in taxes. Yep. And your initial reaction was like, you're crazy.
Yep.
Well, what's the flip? How much do you have to make to qualify to pay $1 million in taxes? So on that note of just the, hey, things being, higher, sure, are there deductions that more things that can happen? Could you end up at a zero? Sure. But is that ideal? No. Ideal would be you've got some profit. On that, I've got a little story to chime in on. So I had someone that I met with who, this is a telephone game. So what he related to me, his understanding of, he had gone to one of these, big seminar, motivational, rah, get into real estate investing kind of a deal. And what they were teaching at that of why real estate is so awesome for you. And what he came away with, there was a slight misconception. So in case there's anything else out there, someone has this, I want to clarify. So there is a difference in how it's represented on your tax return, what tax there is between selling the home and the rental income monthly. Selling the home, there is capital gains involved. The regular monthly income that comes from rental is not capital gains, and that was a misconception. So someone came through, did awesome for the year, they had like $40,000 of rental income and had budgeted for long-term capital gains on the rental income and had not budgeted for it to be, in essence, ordinary income. Regular income, he pays a regular tax now. Again, not the Social Security or Medicare, not that extra stuff like the wage. And so there was that kind of heartbreak moment at that, we record history. I can't change what happened last year. I haven't planned for the future. And so it was, not the funnest conversation, but again, if we go through and kind of say, hey, here's how things work, only one person in many years has experienced that, but that one has stuck with me.
Yeah.
And so I will relay that to anyone new getting into it, just to clarify, let's not confuse this piece.
And to be clear,
Mm-hmm.
the long-term capital gain tax rate for many folks is 15%.
Yes.
And the ordinary income tax rate in that scenario is probably between 22 and 32%, right? And so when Charlie is talking about, this person came in expecting 15% and instead is paying 24%, for example,
Sure.
that 9% increase is quite a lot.
Yeah, absolutely. And so thinking on that, jumping into the income, the profit, and how that actually works in your taxes is the comparison I like to draw. And we kind of touched on it. So there's a great similarity between a business and a rental home, right? Mm-hmm. So just like a business, there's a profit and loss. That profit and loss, I start with my gross income, take all my expenses, and I only tax on my profit. A rental is almost the same. What are all of my rents for the year? And then we take off all the different expenses that come out of that. And then the net in the end is actually what ports through into your tax return. That's what you pay tax on. So if you have, make the numbers really easy, $1,000 a month, you have $12,000 of rent for the year. We have all the expenses, and let's say the profit is $2,000. Great, you're taxed on $2,000. You're not taxed on $12,000, which is nice for those that are maybe paying on that home. You're, having someone pay your equity into that. And so there are some definite benefits to that in that way. And so that's also how does it help me on taxes? You're not paying tax on $12,000. You're only paying tax on the profit portion of that, which is nice. So you have things that offset a lot of income. But in the same way of how does it help my taxes? Well, you want $2,000 of profit. You're hiding 10. That's great. But you're still paying tax. I am technically making your tax return worse by adding $2,000 of income.
Yeah, the more successful you are, the more tax you pay. This is the generic sentiment that you should take from the way that taxation works. The more successful you are, the more tax you pay. Okay, so in regards to just the income and expense side of things, let's dispel a very common misnomer.
Oh, no.
So let's use the example that you gave of $1,000 a month in rent. Okay, so we got $12,000 a year, except 1 month of the year the tenant did not pay. They weren't able to pay, and they're not going to end up paying that back at any point, right? So they lived there, they didn't pay 1 month's rent. You're in the process of evicting them or something like that, and now they're paying, but for 1 month they did not pay.
Yep.
What many people want to say is, hey, Kevin, by the way, I lost 1 month's worth of rent. And they want to use that as a tax deduction. Now, here is where I need you to listen to logic, okay? Because the emotion of this is, I've lost money on the rental. Yes, you did. But if you don't own a rental property, you lost all of the potential profit from the rental property, right? I don't own a rental property currently.
Mm-hmm.
I'm losing all of that profit from the rental property. Do I get to deduct that loss? No, I haven't made the effort and put in the expense in order to acquire a rental property. And so I don't have profit from a rental property. I don't receive a monthly payment, right? But that's not a loss. It is an opportunity loss. Sure, I've lost the opportunity to have generated that monthly income. But in the scenario in which you are leasing out a house and someone doesn't pay a month's worth of rent, then instead of receiving $12,000, you've received $11,000.
Right.
So if what your goal is to deduct from your income $1,000, guess what? You've done it. You have done it by not collecting it.
You only pay tax on what you collect.
Yep, you still have all of your expenses. So we're reporting 100% of your expenses, but only 11/12 of your rent, right? And so a lot of people go, wait, what? No, but I lost the month of income. And I'm like, I don't know how to tell you other than this, right? You didn't receive it. Therefore, we don't pay taxes on it. Therefore, we're not reporting it. Therefore, it is deducted from your top line. What they want is to not report the $1,000 of income and report another $1,000 of opportunity cost or loss.
Like a double dip.
Yep, which of course that's not what happened. You didn't lose $2,000, right? It's an opportunity cost, but there's every single person alive has opportunity cost.
Right.
They're not living up to their absolute fullest potential that they could be.
So to carry on that one, there's sometimes I will, depending on the right environment, throw an extreme scenario to that when the drive isn't happening. So let's say, for example, you can deduct the rent you didn't earn. So my advice to you is to, in November, kick your tenant out, change your rent to $1 million, and then nobody paid me in December. I get to deduct my $1 million of rent that I didn't collect, correct? While it is extreme, it does also help paint the scenario, right? So it's just the extreme.
Yeah.
Like $1 million. I didn't get the $1 million. Nope, we pay no tax. Rental property equals pay no tax. This is the best solution ever. Everybody has to have one.
Well, and let's go into a less kind of edgy version of this, right? And a more applicable version, like Airbnb.
Sure.
Right? So, for example, you have someone who lives there, every weekend.
Mm-hmm.
But for the other days of the week, no one's living there, right? So the opportunity cost for those other days, if it's the same as the weekends where people are actually paying the rent, then you would end up writing off the vacant days
Right.
and claim the occupied days and you would end up washing out and probably having a loss every single year, no matter how successful your Airbnb is, right? And so this is why the opportunity cost is not deductible, right? The question is, what did you bring in? And that's the top line, right? That's the revenue. And what was your actual expense? What dollars went out?
Right.
And then we arrive at your profit. Now, it's a whole lot more complicated than that, right? But that is the essential nature of the taxation piece of this.
So kind of going through the rental incomes and thinking more of the tax return itself. So we've got our income or loss. That can happen. Sometimes with, as we'll get into the details, depreciation, one of them running off a part of the home itself. So we have rent, or you started it in August, put a bunch of stuff into it, had some, a tenant there in October. And so on paper, it shows as a loss for the year. How does it actually integrate in your tax return? So again, the $12,000 with $10,000 of expenses, we have $2,000 of income at whatever your current tax rate is. So brief recap on tax brackets. As you have the first tax bracket and fill it up, that one's full, the next one. Tax brackets are never retroactive. They only help you know any more income you have, what that tax will be, right? So if your wages have put you on a 22% tax bracket and you have another $10,000 of income, the only place they can live is in a 22% window. And so that $2,000 will be at 22%, and that's kind of what it is. On a loss, it's unique. Normal deductions would reduce your income directly. Rental property, there are as many other things in taxes. The IRS has drawn kind of imaginary lines in the sand that says under the threshold, certain rules apply. Over the threshold, different rules apply. So there's a magic number of $150,000. So where your total income is, if you have a rental loss under the $150,000, generally you can just take it up to about 25 grand and you're okay. If you have more than $150,000, good for you. Maybe you and your wife together, you guys make $250,000 for the year. You put a lot of work into this rental property. You're out of pocket like 30 grand for the year, and the tenant started in November, and so you have like 2 months of rent. So in your mind, you have a pretty hefty loss on your taxes. Because you're over that $150,000 of income, the loss won't actively calculate onto your tax return under normal circumstances. There's a catch, but what will happen is it's never gone. You don't not get it. What happens is it, I use the term bucket, but it's saved, right? And carries forward to either offset future rental incomes or when you sell that property. And I like this on purpose. So I'll say this in a way that I tell clients all the time is if there's a way to legally move an expense to a year you have a spike in income, like selling the house, that's the best thing ever. Yeah. So while you wanted the loss this year, would have helped this year, when that rental property sells and you have an extra $80,000 of income, if we're legally, because it's not that we're electing to, we have to, right, but now we want to move it to that year, that works out the best. So it's never a bad thing for that to happen. So the catch is there is a term, something called a real estate professional. Real estate professional is kind of a high bar, right? It's not just I have my real estate license, I get to qualify for this. Real estate professional, if this is your job, you spend more than like 700 hours, right? Yep. And it's more than your other hours that you work during the week anyway, then could you qualify as a real estate professional? You could, and it breaks that $150,000 barrier. That's really all it is. It's a kind of high bar. Yep. So if you're actively managing like 12 rental properties and your spouse works and you don't, could you be a real estate professional? I mean, sure, that could easily be. Yeah, in fact, that's the most common scenario that I see, right? Is you've got a working spouse and a non-working spouse. Yeah. And the non-working spouse is actually a working spouse because they're spending all of their time trying to micromanage and be the landlord for the rental properties. Yeah, no, keep going. Yeah. So, in regards to that, that's called passive activity loss limitations, right? That essentially rental properties are considered a passive activity. Now, that's to your benefit for purposes of not having to pay the Social Security and Medicare tax. But it is to your detriment in the sense that Charlie is talking about, where your losses can be limited in some cases. They're not
those losses are not forever lost, but will carry forward as long as you own the property, right? And eventually will be unlocked to offset gains. So my only pushback on what you're saying is that $1 in your pocket now is usually worth more than $1 in your pocket later.
Fair.
Right. And so the more money you have right now, the more rental properties you can acquire and all that kind of stuff. But that being said, with the way that tax brackets work, I generally agree with you that it is a benefit that you can claim those losses in the future as opposed to claiming them to further exacerbate your losses and that kind of stuff.
I have a bad habit of when there's a negative thing that happens in my tax appointments, I put the best spin on it I can.
I know.
Here's the glass half full. There is a half full here, I swear.
Yeah.
And I live there, so I communicate in that way too.
Yeah. No, I hear you. Okay, so the next really, really common question that we get is how should I form my business, right? I'm doing air quotes for those who cannot see us. How do we form our business for renting out these properties? And so what a lot of people want to do is just jump right into the LLC side of things. Some people just buy it as a sole proprietor, right, just in their name. Some people want some legal protection and that kind of stuff. Now, this is a pretty nuanced topic, so I'm going to be a little long-winded and have a couple of soapboxes in here. Okay, you're looking at me funny.
I'm thinking about how to say it right. I'm like, we need to have a little bookmark here for like, see these other podcasts for the LLC soapbox. I'm just ready to go.
Yeah, exactly.
For those that have been listening, you may
Insert
already
here.
already know where he's going to start with the LLC.
That's okay,
thing.
Charlie,
I'm
because
just prepping myself for it.
repetition is the mother of all teachers. So, essentially, my recommendation in most cases, so I'll just give you my answer real quick and then we'll jump into the thought process behind it. But my answer real quick is you generally should be a sole proprietor, right? Owning rental real estate, you generally should be a sole proprietor, but you need to have an umbrella policy out on all of your assets. And so the umbrella policy, the insurance is tax deductible. It would help you in the case that you end up being sued. Because what a lot of people do is they want to go the LLC route, right? And a lot of people can't even tell me correctly what LLC means, right? An LLC is a limited liability company, not a limited liability corporation. Having a rental property in an LLC that is solely owned by one party, generally speaking, is not going to give you the limited liability that you are seeking, at least here in the state of Texas. There's something called piercing the veil of the corporation. We've discussed before, but I mentioned it again. Piercing the veil of the corporation to get to your personal assets. When the corporation is solely owned by one person, then they want to commingle business assets and the personal assets. Very, very common. Now, the one LLC probably isn't going to do the trick. What most lawyers end up recommending when you own multiple rental properties is that you have a different LLC for every single rental property.
Right.
And then you set up a partnership which owns all of those LLCs and you own the partnership, right? And so it ends up being an asset protection strategy, which is great. I'm sure it's great.
Mm-hmm.
The problem is for income tax purposes, when each of these properties could be incorporated and one holding corporation holds them all, you end up having to file, if you've got 10 rental properties, you end up having to file 12 or 13 tax returns,
right.
Which is very cost prohibitive, right? Because if it ends up that you've got, $3,000 of profit per rental property per year, and the cost of the tax returns are $1,000 each, you're eating into your profit big time.
Right.
And so,
what kind of insurance policy do they have for $10,000 a year?
That's right, exactly. And so that's generally my recommendation, is that people pull out an umbrella policy on all of their assets, both personal and the rental assets, which then ends up covering a large majority of your legal liability issues. And so some people want to say, well, what if I was an S corporation? My S corporation owned all this stuff. Well, that's fine. You can go that route, and one S corp owns all of this stuff. Piercing the veil of the corporation becomes more difficult, and then you file under the S corp side of things. More things potentially become deductible, right? A computer purchase to manage the properties, your cell phone, more of your miles, business meals, that kind of stuff. Because the S corporation is not a passive activity, right? The S corporation is active. It's a business that you are actively conducting, and so there are more appropriate deductions through the S-Corp route. Now, that is a separate filing, and there are thresholds at which it probably is better for you to file as an S-Corp. For example, one of the issues that you've got, at least here in the state of Texas, is you cannot hold more than 10 mortgages as an individual. So if you want to leverage the bank's money to then earn a profit on rental properties, not buying it cash, but getting a mortgage from a bank, you can only grow so much as an LLC that there are very different rules in place for how many mortgages you can take out and that kind of stuff. Well, no, what I specifically mean is an LLC,
Okay, sure.
right? But the issue
I was
here,
thinking of your actual example and.
right.
Sorry.
But the issue here is the LLC. So I'll explain what Charlie's talking about. The LLC does not equal S-Corp. S-Corp does not, S-Corp usually equals LLC, but essentially you can have an LLC taxed as a sole proprietorship, right? So you can have the rental properties in an LLC and we report them on your personal return, but you're not going to get the limited liability protection that a limited liability company is supposed to offer you. And so the S corporation route provides you a little more of that limited liability, and much harder to pierce the veil of the corporation, and more tax write-offs. The thing is that there is a threshold at which the S corporation is really actually helpful, and so you need to, because there are costs associated with that. You've got to have board meetings and minutes and all kinds of stuff. So there are some administrative headaches that come with the S corporation. And when to transition to an S corporation is really subjective. There's not an objective method of determining when the right time to move is, because the way that I usually explain this is if you could save $1 by transitioning to an S corp, but it's going to cost you 30 hours a year of your time, would you do it? Right? Most people, the answer to that is no.
Mm-hmm.
What if I could save you $1,000? Would you do it? 30 hours? Probably not. How about $10,000? Well, okay, yes. So you see, there is a threshold.
Right.
But that's a subjective threshold because that's going to depend on each person, right? Somebody says, even if it loses me $1,000, I want to be an S corporation because I want to be able to say that I own a business, right? Or something like that.
Sure.
Or, I want to do it now because I want to get used to it so that as I grow, I can be more expert at doing this or whatever, right? The point is that it is subjective. There's not an objective-based formula of when it is better to be an S corporation.
For rental properties. We had the other conversation previously about businesses. There may be, but this one not.
Even then, there is a subjective level, but I hear what you're saying.
Yes.
Yeah, absolutely. So that if obviously that is a complicated and very there's a lot of minutia with that subject. Okay, very involved, and we're not attorneys, right? So we're not providing you paid legal advice or anything like that. What we're doing is giving you some incidental pointers in the taxation of the thing that has implications on the legal side.
So my turn for the slightly long-winded side of things. So jumping into general expenses to rental property, I'm going to touch on mortgage and depreciation. Let's head it off, right? So the mortgage side of things. To head into the mortgage, the reason I'm bringing it up as far as expenses, a very common thing for someone to say is, well, I pay $1,400 a month for the mortgage, therefore my expenses equal $1,400 a month. And I don't disagree, missing the word there, disagree with the bookkeeping angle of that. And that's one thing that with taxes.
From a cash flow perspective.
Or cash flow.
Sure. Right. So cash flow, because bookkeeping actually is different, but for cash flow purposes, for cash flow purposes,
correct.
You're right. $1,400, I have $1,400 less in cash flow.
Correct.
Yeah.
And that's a common thing in taxes, whether it's business, whether it's rental property or whatever, the cash flow, bookkeeping, tax worksheet, as it were, will disagree for reasons on that, right? So the mortgage itself, I'm going to use the word It's my common one, so I'm trying to replace it in my head right now, but I say I don't care. So it's irrelevant. The mortgage itself, technically irrelevant. What I need when it comes to taxes is it's the pieces of the mortgage that we have to allocate. One important thing with taxes in general, business, rental, whatever, is the more categories we can put things, generally speaking, the better it looks.
The less likely you are to be audited.
Correct. It's always important to be accurate, but it is almost equally important to make it look accurate, right? So I have to break these things out. So the mortgage itself commonly consists of interest, principal, insurance, and taxes, 4 different categories. Now the interest, the insurance, and the taxes go directly against your rental income. The principal does not. The principal is done in a different way. It's done via depreciation. Now it's different than what you're actually paying. When you have a mortgage, generally speaking, I think of, because for those who are not watching a visual, I think of a pyramid and a flipped pyramid, right? 2 triangles, one pointing up, one pointing down, right? And then a line, a Tetris line going across those pyramids, boom, 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 boom.
Did you say Tetris line?
Yes, Tetris line. Knock it out. It's gone. Knock it out. It's gone. Because it's just across the line. And so the first payment you make is almost the butt end of the triangle, all interest, and the tip of the other triangle, a little bit of principal. And so as you pay more, you have more and more ownership of your home. The joke I make, we bought our home in 2014 or so, as I tell my clients, I think I own like 3 tiles in my kitchen. That's about what I own of my house because of just how those are structured. Taxes is different. The principal that we write off is in essence, straight number all of the years. It's 27 and a half years. So I'm going to take a flat number, which means that for the first number of years, when you're at that tip of the pyramid, you're paying very little amount of principal. I'm actually deducting more than that. So it's not a bad thing for me to say that your mortgage is relevant. I don't care about that when it comes to the math for the profit of your rental, because I'm actually going to deduct more than you actually pay for a while. Now, on the flip side of when the house is almost paid for, it feels like your profit is higher than your cash flow is. It is what it is. But that's an important thing. So the mortgage itself is important for you on the how does it feel? Is it worth it to me to get this property? Absolutely. It will look different commonly when it comes to the tax return because of just how I have to separate that out. And so when we're looking for, you're talking to your tax person, doing on TurboTax, whatever that is, plugging in your mortgage number isn't accurate. We have to do different pieces. Depreciation itself, there's another caveat to depreciation. Well, I'll take it as a straight deduction. The other things that are depreciated, we'll get to the other half of that in a second, but it's important whenever you have the different expenses, different categories, we do have to separate repairs versus improvements. So a permanent improvement to the home, I'm going to sell the house for more because of this. I put in a new AC, I put in a new roof, right? I added a room to the entire home, right? Those kinds of things need to be depreciated. If you just replace the word depreciation with deduct over time, essentially that's the same thing. So right off the roof, not all at once, over a set duration of time. Or right off the new addition to the house, over a duration of time. And that's how depreciation ends up working. Now, depreciation, you're writing off your cost. We'll get into the ramification later, but just a quick purge on that, just like anything in business. If I pay $100 for a thing, and then I write off that $100 as a business, now what I have paid for that thing is $0. So when I reconcile later, I have to reconcile that I have now in essence paid $0 because I already wrote it off.
Yeah, so
depreciation works.
Yeah, essentially that is cost basis.
Yes.
Right? So you know, yeah, you buy the AC unit for $7,500.
Yep.
You deduct that $7,500. You know, it ends up being in a scenario that AC unit has now cost you $0. Not because it actually cost you $0, but because you wrote off the expense, you have zero cost basis in the AC unit. So it doesn't increase your basis in the property by that $7,500 because you already wrote off that $7,500. Yeah. So depreciation actually is
Up there. Yeah.
yeah, it's very multi-layered. There's a lot of nuance to that. So feel like I keep using that word, but that's taxes in a nutshell, right? We're trying to.
Using that word. What do you mean?
It means exactly what I think it means, actually. But thanks, Inigo.
I just want to use that quote. I was just thinking of that movie. I was like, I gotta use it somehow. There we go.
Yeah.
Use it anyway.
Yeah. Anyways, so okay, there's a little bit to unpack there because in the scenario in which I just wanted to kind of go back a little bit
Okay.
to your pyramid, which I've never actually heard you use that explanation before.
Sure.
I don't hate it. It's pretty good visually. Essentially, if you use that as an example, let's put some numbers to it.
Sure.
Because let's say for a moment that you're collecting $1,000 a month in rent, and that you're paying $1,000 a month in your mortgage payments, right? So you think, well, I'm not making any money on this, Kevin. No, I know you aren't bringing home money on this. I get that, but you actually the taxes here have to be accounted for, right? And so in the scenario in which it is at the very start of the loan, and 5 to 10% of this is actually going toward principal,
Right.
and we're writing off 1/27th of the property each year, it ends up that you're paying $1,000 on the mortgage, and 900 of that is interest, insurance, and property taxes, and we end up picking up another whatever $500, $800 in as far as what is deductible for depreciation. You add that to the other expense, then you're actually a lot more negative than you think you are for income tax purposes, which is great. But eventually, you're going to be more positive than you think you are, right? And that's the issue with how people want to look at their books and look at their cash flow versus what is reported on the tax return. I had an experience once where someone was looking at the depreciation schedule. There are some limitations in what you can deduct annually for depreciation. There is a $2.5 million threshold and that kind of stuff. I had someone once looking at their depreciation schedule and going, Kevin, what did you put on here for $2.5 million? I think you made a mistake. And that's only entered inherently on the form. I don't actually enter it.
It's default. It's printed.
Exactly gets put on the form as a threshold, right? As part of the calculation, because it can't be more than this 2.5 million.
Right.
And of course, this person who was doing a good job thoroughly reviewing
Sure.
the work that we did, which is good. I commend that attention to detail. It will serve this person well over the course of their life. I just had to laugh because I'm like, oh no. We didn't write off $2.5 million of depreciation on your tax return.
Right.
This is just an auto-populated number for calculative purposes. So
Was this over the phone or was this in person? Do you remember?
it was over the phone
Okay.
that we were discussing.
Because I have actually, probably everybody in the office here may have an experience like that. Because when you say that, I still remember having an experience like that too.
Mm-hmm.
Before I was doing taxes, part of the training was just I would when people come in to pick up their tax return, would go over the pieces, and we spotted that one time. And so me at that time not understanding, them going, what is this? And me having a minor heart attack while I hunt down whoever prepared that tax return.
You're going, I don't know.
Come answer this question. It would be funny if it happened to be you at that when we have a similar memory, but if it was over the phone, then it wasn't that way.
It could have been me, but no.
It still could have been.
Very
Sure.
likely was not, unless I was traumatized by the experience. Just don't.
So if you see that number and freak out, you're not alone.
That's right.
We've
That's
all
right.
had that moment.
That's right. Cascading into kind of from depreciation and the mortgage, which
Yes.
are common expenses,
Yes.
very common.
Yes.
Let's dive into the other common types of expenses, right? So, the insurance and the property taxes, those are costs that you're almost always going to have. I had somebody that had a rental property that was not insured. And I thought, please,
Get something.
I begged this person, please go get insurance. I mean, it's deductible as well.
Mhm.
So you're going to get some benefit from deducting it, but my goodness, your entire asset is at risk, right? So very fundamental. You must have your rental property insured, please. Even though the insurance is higher on a rental property, it will cost you more than your homeowner's policy for your primary residence. But going into common expenses, we're just going to kind of go down a list. I mean, the reality is When it comes to rental properties, there are common expenses. There are also uncommon expenses. We're not going to dive into the uncommon expenses today. Maybe we'll do a case study or something like that in the future where we can look at some of the uncommon expenses for rental properties. But today we'll cover primarily the common expenses. Now, one thing that, frankly, most tax professionals don't understand, because what they do is they read the law and they stop at reading the law. And once they've read the law, then they're done and they think they know how to work it. And as per usual, the law is not sufficient. So, and to soapbox for a moment, and I've said this before, but again, repetition is the mother of all teachers. The IRS, using the law, loses in tax court about 50% of the time. The law is not sufficient. It isn't, period. If you think that you can just follow the law and everything will be fine, you are wrong. It won't.
There are times where it's abundantly clear.
That's correct.
There are plenty of times.
That's right. Because 50% of the time, the IRS wins.
Correct.
Right?
Yes. Using
Using the law. So, but the whole point is it's a tightrope, right? You've
Right.
got to walk the tightrope. So, essentially, this point that I'm making is when it comes to security deposits that you collect.
Oh, sure.
Because what the law says is security deposits are not taxable income. When you collect a security deposit, it is not taxable income. If you escrow the funds.
Put them in a separate account.
That's right.
Catch it.
Yep, you have to escrow the funds. No landlord that I've ever worked with does this. None.
Right.
So how do I treat security deposits? They are income because you're taking them and you're putting them in your bank account. But that means when the tenant leaves and you pay them because they were a great tenant, you pay them that security deposit back, that security deposit is deductible.
Yeah.
So it's actually a common expense. Now, it's not really shown actually as an expense. We show it as a negative income line because you showed it as a positive income line before. But ultimately, that actually becomes something that is taxable income and deductible. And don't let anyone tell you different, because what everyone else is relying is the law, which says you are escrowing these amounts. And these people, generally speaking, are not. And because they are not, it is taxable. So that's kind of a common misconception that I
Sure.
wanted to clarify. Now, beyond that, homeowners association dues are tax deductible. Advertising costs, like a sign, for lease, stuff like that.
Sure.
Paying a real estate professional in order to find you a tenant, a
Right.
commission, usually first month's rent.
Right.
You've got gardening, landscaping, and mowing, that kind of stuff, right? Paying for lawn care, pool maintenance, that kind of stuff. Cleaning. So you pay a cleaning service to come out after a tenant has left. That's pretty common.
Mhm.
More rare is a landlord paying to have a home cleaned while there's a tenant there.
Right.
I
I'm going to pay
haven't
for a
seen
maid
that.
service.
Yeah,
In your own
yeah.
house.
But post tenant leaving, very often they're
Yes.
paying for someone to come clean the house. You've got management fees. Obviously, are immediately deductible if you're paying a management company to handle the stuff for you. Legal and professional fees, for example, part of the cost of preparing the tax return is wrapped into preparing these schedules and forms, asking you expenses, collecting your information and reporting it correctly. So a portion of our fee is deductible there as a business expense. Eviction costs, closing costs on actually purchasing the rental property, and those types of things. Refinancing, those types of costs are deductible. You've got pest control, painting, and decor, furniture, appliances, that kind of stuff. Air filters. I've got somebody who goes and changes the air filters every quarter, and so those air filters are not super cheap. And if you've got quite a few properties, that ends up adding up. You may not think that it's a lot, but those types of things multiplied over many times adds up to a lot of money. And then of course you've got your plumbing, electrical work, and your general repairs, AC work, electrical, and all that kind of stuff, right? All of the maintenance that you generally think of when you think of homeownership, right? So I'm sure we all have those stories of you bought a home and you remember what your first major repair was on your home, because my gosh, after living in an apartment and then transitioning to a home, you think this is all fantastic, wonderful, and amazing, and then you're hit with that first bill, and you're like, "Holy cow, I have to pay for this!"
Why did I do this?
Yeah, and so as a landlord, of course, you don't even get the benefit of living there, and you end up having to have those expenses. And so then beyond that, you've got, of course, the property taxes that are deductible, and then you may, as the landlord, pay some or all of the utilities. Now, by and large, the tenants will pay for their electricity and their water and that kind of stuff, but like trash usually, or if you need to pay for the internet in order to have an alarm there at the house, some landlords will do that kind of stuff. Permits and licenses that you're required to have, like an alarm permit and that kind of stuff.
Or while it's vacant and you're fixing it up and cleaning it and getting it ready for the next person, utilities and that.
Yeah, you're paying for the electric and the water and all of that. Yeah, for sure. So obviously there's a lot. Miles to and from the rental property, miles to and from Lowe's and Home Depot, miles to and from any location,
Right.
for purposes of leasing out the property, right? That kind of stuff. So that's kind of
It's a lot easier than miles whenever it's local.
Yeah.
When your rental property is 5 states away.
Yeah.
Right? And you bought the rental property next door to your mother, and you drive to visit your mother, and I went to my rental property. There's a proration we should honestly apply to some kind of scenarios, so don't take it as anything but generous people.
Yeah, this is what people want to do, right? What they want is they want to, incur an expense that benefits them personally. Like they want to buy a boat. Oh, this boat is for my tenants in my rental property or my business or whatever. They want to buy the boat for $40,000. They want to deduct the boat and they want to use the boat 1% for business, and they want to call that boat a tax write-off. And It's like, no, it's the business percentage use, right? And so people think of things all or nothing. All right, it's like light switch. It's off or it's on. It's right or it's wrong. Yes or no, black or white. It doesn't work that way, right? If it's you buy the boat, it's 1% business use, then you write off 1% of the boat. So kind of a tangent there, but that always yeah. So in this scenario, to bring it back on track, in the scenario that you're talking about, my question will be, how many days were you there? Right? Oh, we were there for 5 days. Great. Would you say that one day was primarily used for going and checking on the home, talking to the tenants, taking care of business up there, right? Because it's not going to be less than 1 day. It probably will be less than 1 day, honestly, but I'm not going to claim less than 1 day.
Sure.
I'm not going to prorate by the hour, right? So in that scenario, I'll take 1/5 of either the airfare if you flew or the miles if you drove, 1/5 of the hotel, that kind of stuff. So that's kind of the most common expenses. Do you think I missed any? I'm sure I did, but by and large.
There's a good list of those things, just about everything that's there. I think that was pretty good. So just the takeaway that I have is the small little caveat I give to some folks is there are your main home and your rent home, there are some stark differences. So your main home, we get interest and taxes and you're done, right? Yep. The rental home, all the other things apply.
Everything.
Right? Your repairs, your HOA, your insurance. So everybody wants to deduct their HOA. I don't want to deduct my HOA, no, right? But on the rental business type of scenario, a lot more doors are open in that scenario. So just that one on the main home and rental home, there are differences. So please don't mix them. There are still hard limitations to your personal property, but the business property has a lot more. The doors are open, a little more open room for deductions.
Yeah. Okay. So now let's talk about a more nuanced subject, and that is regarding what.
How many nuanced things we talked about this? We're on 4?
Everything.
4.
Everything. Everything is nuanced.
Okay.
It's taxes, Charlie, right? Everything, it depends. The answer is it depends to every
You can't just
question.
give me a straight answer?
Nope.
Oh.
Well, yes, but no. It depends. So essentially, when it comes to deducting expenses, there's a scenario in which certain expenses are deductible and others are not. I'll give some examples. Let's say I own a single rental property. I charge, it's in a small town, right? East Texas, small town. I charge $600 a month for rent.
Sure.
The mortgage is $500 a month. It's small potato stuff, right? I'm just getting my first rental property. And I buy a $2,000 laptop. Generally, the profit of this rental property does not necessitate you to purchase a very nice computer. Or I want to write off my cell phone. Well, but I'm only use it for such an infinitesimal part of the business, right?
It's not Airbnb, it's a single tenant.
Yep.
Because they're
Yep.
monthly.
Yeah. And then let's explain the scenario of I own 12 rental properties, right? And I'm generating, let's call it $4,000 of profit each rental property every year.
No management company.
No management company. And now I buy a $2,000 laptop. Well, okay, now I'm not even going to bat an eye. Absolutely, we can write that off.
Right.
And your cell phone. 80% of it probably is going to be used for business in that scenario because, my gosh, how many phone calls are you
four
getting?
phone calls while we set to your tax.
That's right, exactly, right? We've seen that firsthand.
Yep.
So the point here is that, again, people want to treat these types of expenses like it's black or it's white, right? I either can or I can't. And that's not the way that income tax law works. So for our purposes, there are thresholds at which certain expenses become more reasonable.
Right.
And so I'm not going to delve too deeply into this because this is a rabbit hole that we can spend a lot of time going down.
Consult with your tax advisor.
Yep, you need competent tax advice in order to determine what things are deductible at what point. I promise you that I will set you up for more success if you are in rental investing than if you are doing your tax return yourself. I will be worth every single penny that you pay me. Someone like me will provide you a really tremendous amount of value. The problem is, Charlie, there aren't a lot of people like us for individuals, right? Who are wanting to learn and wanting to grow.
Right.
So if you want someone like us, my recommendation is that you engage us specifically. Shameless plug.
Let's say the same word. Hey, you didn't nothing there whatsoever. So the next one that at least I have on our list of things we're talking about is then the moving into the sale of the rental property, right? So we're talking about it being active, we have it. We touched briefly on acquiring it, some of the deductible pieces that we have, and then selling it. And so I'm gonna flip our thing because you've been talking about my thing.
Yes, it is your turn.
I have another. I do with my hands a lot, so sometimes stuff on the podcast I think so I have to describe the pyramids because I can do it with my hands when I'm in person.
Yeah.
So when you sell a property, you're selling anything: land, rental property, stock, whatever it is. I'm going to put my hands in front of me parallel, so pointing up to the sky, kind of like creating a zone, a window. When you tell someone I'm this close to stepping on your toe or whatever it is, right? That's the
Charlie, I've never
analogy.
said that in my entire life.
Well,
Not one time.
I was cleaning it up. So, so you have the symbol. So one side of it was PG, right? We have this. Has it been pretty PG the whole time? It has.
Yeah.
So on one side of it, you have the how much you bought it for. I go buy $100 of Google stock. That's one hand. I sell that Google stock for $180. Fantastic. That's my other hand. The difference, the window between, the air between is how much income I actually have, right? Just the difference. Generally speaking, we have the same kind of thing on the rental property. There's just more pieces that move my hands around. So we're going to start with my one hand, my left one is my left. But my one hand is the how much I bought it for, right? I'm going to add to it, move my hand in one direction, saying closer to the other hand. So I'm shrinking this window. Things I put into the house, right? I put it on the roof, I put it in an AC, right? The closing costs from the purchase itself, all those different things, right? And then I have my other hand of how much I sold it for. There's the gap, right? Minus like my closing costs. I'm going to close that gap. So now I have a window. Again, I'm this close to something in tow. That is the income that you have, generally speaking, for selling a tangible thing, right? The problem with rental properties, not problem with, but just the catch is the depreciation factor. Remember how we talked about, like in business, I write something off, what is my cost? So I bought the house for X. Let's ignore improvements and everything from there. I bought it for X. Let's say I bought it for $100,000. I sell it for $120,000. So my difference between the two is 20 grand. However, I've had this rental property now for 15 years, right? I've written off, in essence, half of it. So then I have to make this gap bigger. I'm moving the hand away from the other hand, dropping that purchase price to about $50,000. And now I have a much bigger gap of what the income is on that rental property. You got advantage of all those deductions offsetting your income for all those different years. Now you have the spike in income. Now you have the ability to pay the tax. I'm not saying I agree with it. I'm just saying it how it works. And so that's the thing to be mindful of when you sell that rental property. So there are pluses and minuses, but by and large, that depreciation is going to be what feels like a big minus. It hurts you in, now with my hands close to my eyes like horse blinders, right? It hurts me in this year, right? So this year, it's not as fun, but really we have the deduction and stuff over the time. And so it's just wiping that gap. Here's my income. Bought it for 100, already wrote off 50, sold it for 120. I have $70,000 of income. Again, minus closing costs. We're going to shrink it again by improving stuff we haven't already written off, but that's the difference between there. And so that's how that ends up, generally speaking, on the working side of things. The term is depreciation and recapture. You have to acknowledge what you've already written off. The way to explain it, I explain it in this fashion. The math sometimes looks a little different when it comes to the tax return itself, but for layman term of explaining, here's how this functions, that's my speech on going about that. So just lay it out so that it's acknowledging, and that's the capital gain aspect that we jumped onto earlier. We started with of the rental isn't the selling of it. Now we're on capital gains.
Yeah. It's also referenced as realized gains and losses, right? Because the value of your home may go up, and you don't have to pay taxes on the value going up.
Right.
The value may go down, and you don't get to deduct a loss. It is not a realized loss or a realized gain. The sale is the taxable event. Now, where a lot of people want to come in when we're talking about the sale of a rental property is, well, what about a 1031 exchange?
How should not pay tax?
That's right. What about a 1031 exchange? Okay, so are you ready for the unpopular opinion? I'm soapboxing here, okay? 1031 exchanges are not simple. They are complicated. They are more complicated than you think they are. Generally speaking, our recommendation is that you work through a 1031 exchange company. It's what they do. That's all they do. And that's going to cost you between $2,000 to $3,000 in most cases. That's quite the cost. In order for the 1031 exchange, essentially what a 1031 exchange is, I probably ought to start there. The 1031 exchange is a way for you to, rather than recognizing the gain right now, exchange this property for a like kind property.
Rental house for house.
Yep. And carry over your cost basis from this first rental property to the second rental property. So you sell this property and you buy a more expensive, nicer property. Or you go from a single family residence to a duplex, right? And then you take that duplex and after 10 years of renting it, you sell it for a quadplex. And you keep 1031 exchanging up until you're into commercial real estate. And all this time you haven't paid any taxes because you've 1031 exchanged this. Well, that's the right way to do it, right? Consistently increasing your wealth without paying taxes. I like that. That's the exact reason for the 1031 exchange. However, that's not what most people do. What most people want to do is they want to sell the rental property for a retirement property that they're going to eventually build and live on. Well, that's not a like kind exchange. You can't do that. Or they want to sell this and buy something else that they want to call a rental property, which in reality, they're not sure what they want to do with it. Well, you see the issues here, right? Most people are just trying to avoid the tax. That's all they're trying to do. Now, some have good intent and they want to sell this rental property to buy a rental property, but they're not significantly increasing or putting a lot more money into it. They just don't like this property here and they found a good deal on this one over here and it's worth a little bit more, but they're going to get it for a relatively good cost. And so they want to sell this one and buy this one. And that's fine. But a 1031 exchange is going to cost you $2,000 or $3,000. How much tax are you going to pay? Right? Because if the tax that you're going to pay is $6,000, and because again, the shrinking of the gap in the hands, right? The whole point is that you generally are recognizing less profit than you're expecting, depending on how long you own the property.
Right.
The longer you own it, the more depreciation you had, and so it can be larger. It depends on the scenario. But essentially, this 1031 exchange in many cases, people want to effectuate a 1031 exchange where it's just not appropriate, right? Do you think taxes are going up or do you think taxes are going down? So for reference, in 2021, we're right on the cusp of the capital gains tax rate increasing. And it's going to increase really significantly, depending on your income bracket. I've advised clients for the last 12 years, don't 1031 exchange, just pay the tax. And for every person that heeded my advice that would have sold it under this higher capital gain tax rate, they're better off. Now, it's easy to look back and say, I was right? And that's not all I'm saying. My point is that fundamentally, the 1031 exchange is a method to grow your wealth and to save you money. If it works, it does not work in every scenario.
Right.
And everyone thinks that it's good for them because they don't understand the varying aspects and the costs associated with the 1031 exchange.
It costs a bunch, but also just moves the tax to a different year.
Yep.
You're not eliminating the tax.
That's
So
right.
you're just saying, I'm going to move into this property. So when you sell that property, then you recognize the tax then. So you're younger, you get the house, you're on the cusp of retiring, you switch to the other house, it's still a rental property, it's a rental property for another 10 years, and then you sell it deep into your retirement. Well, now you have that big gain or bigger gain deeper into your retirement. That's just what will end up happening. Is that the best?
Yeah, and that's fine because again, $1 in your pocket now is worth more than $1 in your pocket later.
Sure.
Because you can invest in without having to pay the capital gains tax, you have more capital to invest in a more expensive property. And the more you grow the property or properties that you own, the more your wealth grows, right? So there's reasoning behind all that, and it can be a great thing. In fact, in that scenario, I think that's exactly how 1031 exchanges are supposed to work.
Right. But it's the tax change difference like you're talking about.
Right.
The
And
counterplay.
there's another piece of this because some people say, I'll never recognize the gain. What I'm going to do is I'm going to keep growing all of this, and then I'm going to die with this property. And when I die with this property, my heirs get a stepped up basis, meaning it's a reset of cost. So if I start with a $100,000 home and I end up with $15 million worth of commercial real estate, and I die, and it's worth $15 million on the day I die, my beneficiaries who inherit this get a stepped up basis of $15 million, and they turn around as quickly as possible,
that's their cost
8 months
basis.
or $1 million. They sell it, and they have almost no gain. Now,
versus your gain of like, you wrote everything off and
yeah,
10
$15
grand.
million.
Right.
Yeah. So the issue here is the stepped up basis is very likely going away. That is also a piece of what is very likely going to be legislatively changed. So again, it's easy to look back and say, I was right, but I get to do that because I advised people for years,
Just take it down.
unless this is the direction you're going and growing your wealth through rental properties, right? Either residential or commercial. Unless that's where you're going, don't 1031 exchange. I went through a 1031 exchange session, if you will, with one of my clients who was selling something for quite a lot of profit. And we looked at what it cost and what the tax was. And ultimately, because I actually talked to the 1031 exchange officer. And so it was a three-way call, and we were talking, and I explained what the tremendous value of a 1031 exchange is, and what the downsides of the 1031 exchange was. And of course, this 1031 officer was trying to
Sell that product.
exactly, yep, it was a she, so she was trying to sell her product. And I get that, and I was trying to give her all credence and talk about all the good things. But I'm also paid to represent my client in their tax and financial matters, and so I'm trying to explain, anyways. So obviously this is a long soapbox, and so I'm gonna taper this down. But the point is, 1031 exchanges have a place, and they're not for everyone. Don't do it willy-nilly. I have seen people pay more to have the 1031 exchange happen than they would have paid in taxes. Wild. So, okay. Last point, You want to cover?
Last point that I think I have, I don't know if we wrote it down, I just thought of it, was when selling a home, rental property, primary home or whatever, one thing to divorce, separate, keep different in your mind is cash that you get, what the title company is giving you, you're putting the next house, you're giving to you as a check, is different than the tax number. Often the tax dollar
Meaning the
amount.
income?
The income.
Understood.
Correct. So in the scenario of hey, you have $70,000 because of all the depreciation you have, $70,000 of income, well, you sold it for $120,000. You may be getting a check from title for $110,000, but you're only taxed on $70,000. So don't worry about necessarily how much money you're getting by selling the house. That is not, sometimes it is, but often it is not the same as the amount of income. Often the income is less than that. So let's run some numbers, let's kind of make sure, but just because that one sometimes trips somebody up of I'm getting so much out of this. I don't care how much you're getting out of that, and I do, it's a good problem. But the tax, how much you have to report on the tax return will be a different number than what you get physically as money.
Yeah, absolutely. So one final point is in regards to the capital gains tax, because as I mentioned earlier, generally the capital gains tax is 15%. However, on the sale of what's called Section 1250 property, the capital gains actually has some thresholds at which they're taxed at 15%, 20%, and 25%. Correct?
Yes. Yes, but there's a stop.
Yeah.
Capital gains, if I were to, the way I have it in my head, in agreement with you, is capital gains, as general speaking, is a preferential tax. I'm going to pay less than the maximum. And so 1250, there's a little bit more of the maximum, but it's still a lower amount. So if you happen to be in a 35% tax bracket and you only pay 25%, you're paying less.
Yeah, that's
right?
fantastic.
Yeah.
Yeah, absolutely. $100,000 gain, that's $10,000 of tax less that you would pay.
Correct.
Yeah. Okay. Well, that was a lot. That was a heck of a lot. Hopefully, if you own rental properties or are looking into getting rental properties, you got some really good insight. That's going to cover us on the rental side of things. So we're going to jump into our comfort zone. So we'll take a breather, kick our feet up, and Clark, you got some comfortable questions for us?
I've got a really difficult one for you today.
Okay.
I usually give you some easy ones, but this one will be harder.
Okay.
How long should I keep my tax documents?
That is
Wow.
probably the easiest question you have ever given us.
Yep.
Oh, so you're being
I was
sarcastic.
being sarcastic.
Yes.
Jeez, I couldn't even see it. Okay, so this one's super easy. Essentially, the answer is 3 years. Now, the answer gets more complicated because everything in taxes can be a little bit more complicated. But essentially, the answer is 3 years. You need to keep a hard copy of your 1040 and all of the corresponding schedules with a copy of your tax documents, such as W-2s and 1099s, as well as a copy of all of your receipts for 3 years. However, if you underreported your income by more than 25%, the IRS can actually go back 7 years. And if they can prove that you did so fraudulently, there is no statute of limitations. So essentially, the first answer is 3 years, the second answer is 7 years, and the third answer is always keep it.
Right.
My recommendation is that you not defraud the federal government. Based on that recommendation, the max that you would possibly need to keep them is 7 years.
Gotcha.
I have seen scenarios in which people have not understood a certain aspect of like a trust distribution or something where they actually got a bunch of money that they were not anticipating, and it wasn't reported on the tax return. And a couple years later, the IRS then sends a letter, a very angry letter. There theoretically are scenarios in which you have underreported your income by 25% unknowingly.
Right.
Now, they're probably not very common,
No.
but it can happen. And so if you're really a worrier, okay, my wife is fantastic and wonderful and way too good for me, and she worries about everything. And so if you're a worrier like my wife, then you keep those tax documents for 7 years.
You say 7. I say 10. I go off of the collections one though. So
Gotcha.
one of the hidden numbers in the IRS is if nothing has happened, generally speaking, after 10 years, they can't collect on you. It's an odd thing. It's not necessarily I can just say, you go 10 years and you never collect on again. But so mine is the 3 years is the statute, 5 is fine, 7 is long, 10 is extreme for tax purposes. However, there may be other reasons outside of taxes you may keep your tax documents. Depreciation being one of them, a rental home, knowing what you did 15 years ago as far as depreciation, you changed to a new, representation firm, accounting firm, tax firm, you may need some of that history. And so you have to know. But for tax purposes, for IRS purposes, 100% agreement, statute of limitations, everything going well, 3 years is it.
Yeah. And to be clear, though, if you defraud the federal government, there is no statute of limitations. The 10-year rule does not apply if they can prove that you committed fraud. So,
I'm
pretty
gonna
short
add,
answer.
I'm gonna add a part 2 to that.
Okay.
What type of tax documents or receipts should you be saving? A couple examples.
Well, okay, so W-2s, 1099s, right? The 1040 series with the attached schedules.
Right.
When we talk about receipts, we're not talking about your groceries, right? We're talking about things that were used on your tax return in some form or fashion,
Your
right?
rental, like the repairs, the maid service, the pool cleaning of your business, cell phone, the bills, I guess, if you're using your cell phone.
Theoretically.
Yeah.
The point is, the burden of proof is on you as the taxpayer, not on your tax preparation firm. While we keep copies and have federal requirements of what we keep, we often do not keep those copies to your benefit, right? We keep them because of federal regulations. Now, we can provide you with copies upon request. Sometimes there are copy fees if you need something printed out and that kind of stuff, but you cannot rely on your tax firm to keep your documents. You have a federal obligation to keep those documents. What I often find is people keep them too long, not too short. I don't think I've ever had somebody who just told me they threw their tax return away. And so what often happens is people have 10 or 20 or 30 years of tax returns. And I'm like, okay, it's time to burn or shred a massive pile of stuff. I tell people, if you've been coming to see me for at least 7 years, you're golden, right? You can be coming to see me for 7 years. I promise you, unless you are lying to me, I am not committing fraud on your tax return, and you can burn or shred, a bunch of this stuff. Yeah. Does that give you the answer you're looking for?
Yes.
Any little things you think I missed, Charlie?
No.
All right, we got it. And that's our only 2 questions for today.
That's it.
Okay, great. Thanks, Clark, for letting us be comfortable. That one's easy. All right, folks, thanks so much for joining us. I know this was a little bit of a longer session. And honestly, Charlie, I think we probably could have gone for another 20 or 30 minutes. There's so much to this when it comes to rental real estate investing. There's a lot of different programs out there. There's a lot of YouTubers that talk about rental real estate, and you watch HGTV and home flipping, I could do that kind of stuff. In the past probably 10 years, a lot more information has become accessible. If you're looking to get into rental real estate at all, I recommend that you read a book called Rich Dad, Poor Dad, unless you really don't want to buy a rental property, because that book will get you motivated to buy. Rich Dad, Poor Dad by Robert Kiyosaki. He is not sponsoring our podcast, but he probably ought to. Great book, really read it twice, really love it. And that'll teach you some helpful fundamentals. He's a little more passionate about 1031 exchanges. But again, that is the good side of using them, so anyways. But other than that, hope you learned a lot. Thanks so much for joining us. This is Questioning Your Sense with Charles Steinmetz and Kevin Molen. Have a great day.
Thanks for tuning in to this episode of Questioning Your Sense. If you haven't done so already, be sure to subscribe to this podcast, leave us a 5-star review, and don't forget to share it with a friend. If you would like to submit a question for our review on this podcast, feel free to email us at info@molentax.com.